Good evening and welcome to the ShadowTrader Video Weekly for Sunday, February 24th, 2013. Happy Flag Day. I'm going to go through a couple of scenarios for next week, which I think are going to be really key, which I think will be very helpful to everybody to figure out how to navigate this market going forward in the near term. And the reason why things are a little bit tricky right now is for the simple fact that we had some pretty strong selling on Wednesday and Thursday of this past week, which we haven't seen for a while now. It was the first time that we had touched into the 20-period moving average on the daily S&P, which the market had not touched since the beginning of the year. That was the last time that we were at the 20 MA. And the key, I think, to what's going to happen next week lies in the profile and in a couple of Fibonacci retracement areas. So you can see here on Friday we took back a good deal of the losses here. If you look on the SPY, it'll show you a little bit clearer. There was actually a gap up on Friday after some continuation selling on Thursday. All right, putting us kind of right back into range. If we go to the profile, this is where things get very interesting. Okay, I'm going to go backwards a little bit in time and start with what was going on the day of the big sell-off, which was here. That was February 20th, as I said, on Wednesday. What happened basically is around midday, FOMC minutes were released right about in here, and the Fed basically said that they may be looking to put the damper on the QE program, on the $85 billion per month of bond buying. They didn't give any specifics, but they said, look, we may be looking to either ratchet that down or stop this program earlier than we had previously said. Previously, they had said we will maintain, the same level of QE until unemployment gets down to 6.5%. Well, now they're saying they may not do that. Market didn't like that and sold off pretty hard. And you can see we had this move that closed on the lows on Wednesday. Okay, now once you have a move like this where you have lots of heavy selling late day, which causes the point of control, which is up here, to not move down with price, okay, it's telling you that the market is getting itself overly short. It tells you that these are probably shorter term traders which have sold off the market here. As you can see by the little asterisk here, they've closed it at the lows. This usually leads to some fast and furious short covering the next day. What I found very interesting was that the next day, which was Thursday, the market actually opened relatively flat, slight gap down, and actually sold off more and made a very balanced profile, correct? But then had a little bit of an excess low on the bottom. So what I thought would happen on this day is that you'd get a little bit of short covering, a little to the upside, and then a rollover to the downside, but we did not. We actually sold off further. However, in selling off further, what the market did is, you understand, it just got itself more and more short, because we know the market came out short here. Everybody kind of left the day short, and then you had follow through, and they got more short, and then you started to see some covering late day on Thursday, opening us up here, which then led to a subsequent gap up. The O stands for open right here. Subsequent gap up on Friday. Okay, on Friday's action then moved down to the value area and then actually closed pretty strong. So you had the short covering kind of come in one day later. So what this does is this now opens us up to two very important scenarios in terms of what's going to happen next week. So basically the two important levels that we have to watch for next week are either a move to this 1500. It's a big psychological number. 1500, I think, in the futures brings us a good deal lower. Or this area here, which is where all this congestion was prior to the sell-off. Notice that you have all these points of control right the same as the right. All these points of control are relatively equal, so we know we have a lot of value right in this area. Now I want you to pay attention to this number here. This is 1517.50 at that area, and it's going to be really important because when I show you here a 24-hour ES chart upon which I already have a Fibonacci retracement, and I don't know why that's not coming up. Let's see here. Oh, okay, we've got to actually bring this down, probably because we got the Investor RT here. There we go. Okay. So notice the 24-hour hourly ES chart that I have here. So I've purposely marked off two levels here. Here's the sell-off coming down to the low of 1495. And notice here, I've put on a simple Fibonacci retracement from high to low, and look at what happened on Friday. The market took out the 50% retracement and didn't stop at all and actually closed above it. And the 61.8, which is the last line in the sand for the bears, meaning that if the market is going to turn around back to the downside, it would reject at the 61.8. The 61.8 is right at the 1517.50, and what does that line up with? All of the value and the points of control that I talked about a second ago in our profile. Let me bring this down. All right, that's this area. There's your 1517.50. So these are the two scenarios for next week. It feels to me, looking at the charts here and looking at the profiles, that the tone is going to remain to the upside. The only thing that would violate that, like I was saying, would be a move to retest this very prominent point of control at 1500, okay, and bring us lower, okay? There's subtle clues here, I think, in the profile, and we'll see next week if this plays out the way that I'm saying, that lead me to believe that the move should be up. First thing I'm noticing is that the point of control on Thursday's action at the 1500, which is a very key level, is very prominent. By prominent, I mean wide. Notice how wide it is, right? Wider points of control tend to have higher odds of being revisited in subsequent sessions. The market essentially, quote unquote, should go back there. But notice what happened on Friday. The market sold off, and where did it go? Right to value area high, and did not pierce down into the value area at all, nor did it touch the point of control. We never came to the 1500. So that's bullish, because I always want to carry forward information of what should have happened, but what didn't happen. Okay? The other thing that leads me to believe that it's probably going to be a grind up is the fact that the action on Friday was pretty much slow and steady to the upside, right? As opposed to having a spiky move off the open, which is indicative of hot and heavy short covering. Usually what happens when you have a move down, down, and then there's a gap up, this day would look more like this. It would go up, and then the profile would look like this, like a P. And you fill in all of this. You'd have value all in here. And that letter P formation kind of shooting up and then building value later is indicative that all these short-term traders got themselves overly short, and then as soon as there's a gap up, they're like, whoa, you know, and they all cover at once. But that didn't happen, actually. We actually saw some selling off the open, filled in this whole area, value, 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 and then just like I said, slowly, steadily rose higher into the close. So it appears to me that at this juncture that whatever initiating selling there may have been here on the Fed news and then also following through here, given the action here on Friday, it appears to me that the initiating selling, meaning new money selling, that may have happened here since there was somewhat of an increase in volume, was by the day time frame, the shorter time frame players. They then covered their shorts relatively quickly into Thursday's close and then again on Friday, you know, incrementally as the market started creeping higher. Okay? Now, none of this is obviously set in stone. I can't guarantee that it's definitely going to be up, but I'm just laying out the two scenarios for you here so that you'll know what to look for next week. So just to recap, you want to keep your focus next week on this 1518 level here. If we see a daily bar close above this level, meaning above this balance, I think it makes it safe to say that the market will probably continue up a little bit further. All right. If we retest this prominent point of control, remember prominent POCs should be tested. If we keep going and never test it, that just makes me feel more bullish. But if we do retest this area, then we'll have to watch for a possible move lower. Remember that the market can test it and turn around. That's another piece of information that you'd want to carry forward. So if we do go back to the 1500, we'd be watching next week to see how it acts at that level. And if you see a daily close below that, then obviously you'd be thinking a little bit more bearish. Okay. Now, given these two scenarios, I'm going to leave you with just S&P chart here. And given these two scenarios, I want to show you where you'd be looking in terms of the channel. The channel resistance up here is around 1555 on this channel, and on this shorter term channel right here in the S&P, you'd be looking right about here into the 1450. I should say shorter term trend line, not channel. Right about into the 1450, but we probably wouldn't get there to the downside because I would be thinking that this area would be support, right around the 1475 here because it is a prior high. Okay? So there are your two scenarios for next week. On behalf of myself and the entire ShadowTrader team here in beautiful Philadelphia, Pennsylvania, I wish you good trading and good night.